Good morning or good day. It's Monday, 24th of September 2018. We have 5 days a week, 5 different traders. We will speak about 20 ideas, strategies, market screening, maybe 1 or 2 questions from your side. This is our global webinar, real-time daily trading ideas. Let's have a nice start like every day. And like every day, we will start with our disclaimer. Forex and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. If you are a starter, please start with a demo account and make yourself familiar with long trading, short trading, leverage trading, and your personal risk management. If you'd like to read the full long risk disclaimer, just visit one of our web pages, for example, admiralmarkets.com, and you will find everything written down there. Also other information like, for example, key information documents, the kits, everything to find on our web pages. Also information about the different offers for retail clients and professional clients in the European Union. Since August 2018, there's a new regulation effective called ESMA regulation. Since then, retail clients will get a maximum leverage for Forex up to 30. Only professional clients, if they are eligible and apply for that, can still get a higher leverage up to 500. All details about that you can find on our web pages, or a picture shows more than 1,000 words. 2 pictures, 2 examples, DAX 30 or Euro dollar. Here you'll see the margin requirements. As a professional client, you just need 24 euro for DAX 30. As a retail client, you would need 600 euro. Same situation for Euro dollar. And some information more. Retail clients will get an unlimited protection against negative balances. Professional clients depends on the broker. At Admiral Markets, we have an additional protection up to 50,000 British pounds, what is round about 7,000 euro, according to our negative balance protection policy. Also here, all details, check them out on admiralmarkets.com, and here you will see the specific link. This is me. My name is Jens. My English made in Germany, so I'm the German guy from Admiral Markets. We are a big international broker. We have over 18 country offices, but I'm not the main speaker. The main speaker is the day trader of today. This is our usual scheme. On Monday, usually it's Jay's day. On Tuesday, it's Paul's day. On Wednesday, it's Giancarlo's day. On Thursday, it's Marco's day. On Friday, it's Dirk's day. Our leading day traders live. But we are all humans. We are all men, and sometimes a day trader is unavailable. So today, Jay is not here, but Jens is there. So in a couple of seconds, it's Jens' day today. And of course, if you like to trade Forex and CFDs, you get many benefits only with us. For example, DAX 30 or also Euro dollar, triple spread of just 0.8 points or pips during main trading hours without additional commission. Also here, all details on admiralmarkets.com. And if you'd like to contact us, call us or send us an email or visit YouTube or Facebook, everything, of course, also linked on admiralmarkets.com. So, like said, Jay is unavailable today, but next week he will be back. And today it's the day of Jens. So good morning, good day, Jens. What's your view to the markets today?
Yes, good morning also from my end. I have to ask right now, is everything visible here? Because today I have only my laptop screen, not my big screen here right beside me, which just crashed down on over the weekend. And so I just hope that everything's visible right now.
Voice is great, and we see the PowerPoint slide. So let's check
awesome.
if you see your MetaTrader, and then I can confirm also that.
Okay, perfect. So then let's close this. And here, by the way, I've already shared the link here for this great webinar. And this is the MetaTrader.
Everything runs, so go ahead.
Perfect. Awesome. Yes. So good morning also from my end. I'm also located in Berlin. I'm very happy to be here today. And as you can see, by the way, we have a trade running as usual. Our setup, which I really love to present here, since it's a very simple, even though very, very effective setup. On the EURJPY, it's the Asia breakout. It worked really well over the last month. It worked really well over the month before, over the month of August. In July, the strategy had some trouble, but so far it made it back into the green. And I will share with you, by the way, what I'm talking about here, the current performance, some parameters, and also today looks really well. We broke out here on the upside out of this range. The range is defined between 3 a.m. till 10 a.m. German time. We are working here with a indicator, with a filter. This is the purple line, the exponential moving average 11 in this case. Very simple. If we trade above, we only trade short. We trade above, we only trade long setups. That means if we break out of this range, then we take the long side, and if we trade below, we trade the short side. Today, in fact, let's zoom in a little. You can see that it was a very, very close one, but we got lucky, happily. Here, you can see there, the closing price of the moving average in the candle, which is the last candle before we then formulated our setup, was the exponential moving average read 132.186. Okay, so here, and the closing price of this green candle in this case was here. The closing price was, one second, I have to whoop. No. The closing price was 132.19. So it was only 0.5 pips above that, but per definition, it was a long setup formulated. And with the next candle here, we pushed out of this range on the upside, took on some serious momentum, we have to say. So far, the trade is ahead something like 30 pips, 25 to 30 pips here. And we are currently at least having a high chance to go to these highs, then to now see a push back into the range, even though it could happen nevertheless. But the question, first of all, is surely what is this? What's the reason for this green candle, the breakout here on the upside? So this looks somehow quite strong, and the reason can be found in a number which was published in the morning here at 10 a.m. German time. That was the so-called IFO index. It's the business climate index, in fact, and it fell 0.2 points, as you can see here. By the way, I highly recommend this website, tradingeconomics.com. It's more than just a Forex calendar. You can find the economic calendar, Forex calendar, on the website from Admiral Markets. When going here via analytics and there via the Forex calendar, you have all important news available. You can work with the filter here, by the way. So there you can choose your favorite country, the favorite currency, in this case, for example, Hong Kong, the Hong Kong dollar or something, and then filter it accordingly and have all data available. Nevertheless, sometimes you have the question, okay, how can I read this number in relation to former numbers? And there the website from tradingeconomics.com comes into play, where you then have a good chance to put this in perspective. And so very interesting here that, for example, the numbers fell 0.2 points here from a month earlier to 103.7 in September, but they were still beating the expectations of 103.2, and the gauge of future expectations here declined 0.3 points to 101, while the current business conditions, the sub-index, moved down 0.1 points. So all in all, if you read this, it somehow seems as if it was a mixed data set, but still the euro was capable of gaining momentum here, breaking out of this range on the upside, which is, if you ask me, a quite strong sign, because usually you say if data comes in mixed or worse than expected, and here in this case the respective currency can then react in a positive way, that's usually a strong sign. And that's one of the reasons why I feel quite comfortable being long right now. And yeah, just let's hope that here we will see the same as we saw last Monday. Some of you might remember it. Last week we formulated the setup here too, and it worked out. And so, well, hopefully it will happen today too. So here are the numbers around this setup. EURJPY Asia breakout range 131.89 to 132.29. It's a 40 pips range. The setup says we put or replace our, in this case, buy stop. If we trade above the exponential moving average 11, we place the buy stop at the top of the range, which is 132.29. This is the entry long price. And we place the stop below the low of this range, which is then 131.89. We have a risk of 40 pips. And then we work with a statistical component here when formulating our target, which is 1.7 R, which means that if we have a risk of 40 pips, we have to multiply those 40 pips with 1.7. We get 68 pips in this case, it naturally results in a risk reward of 1 to 1.7, and then we have our setup. So 68 pips have to be added here on top of that. It's 132.97, and then you have the setup for the day. So in fact, it's 3 steps we go through here, which means we define the range between 3 to 10 a.m. German time in this case. Then we say we trade above the EMA 11. We go long if the market breaks out on the upside. We go short if we trade below the EMA 11 and break out on the downside. And then we formulate or we set our stop here based on the high or the low of the range, depending on where we break out. And then we'll multiply our risk, which we can calculate by the entry price and the stop price. We multiply this one to get our target with 1.7, and then we have our setup. So this setup here played out really well within this time span. It in fact played out even better, but I started to track this performance here with looking at this special event, and then when I present my thoughts here, because I think it makes sense not only to have a setup itself, but also to show how it performs. And at the beginning, it didn't perform well at all, but we saw a drop here on the downside, and the max DD, by the way, was reached with 5.7%. That's not very much when you look at the fact that we are risking on average 0.9% per trade, even though it's still a sign that here the performance wasn't really well. And there are times when this approach obviously has problems, and this is usually the case when volatility is low and markets tend to break out in one or the other way, on the upside or in the downside, and they're not taking on momentum because volatility is low. And so nevertheless, the approach still has or is still profitable and was so far capable of making back all these losses, and not only that, but push towards or into the green here, with currently showing a profit of 3.3%. We have a hit rate which is quite nice. On when I was on Friday here, we had a hit rate of 50%. Now we had a small gain on Friday too. Let's push the hit rate slightly above 50%. All in all, we should usually see a hit rate of something between 47 to 48%. But somewhere around 50%. So in half of the cases we are on the right side, and half of the cases we are on the wrong side. So the main reason why we're making money with this approach comes with the fact that the payoff ratio, the ratio of average gains to average losses here, is a bigger 1. And here we still have potential on the upside. So far, the average gain to the average loss ratio, the payoff ratio, is 1.12 to 1. So only and slightly above 1. Usually we have, and this is based on a very, very long back test here, a quite long time span, which we analyzed. It can be found around 1.3 to 1, but this plays out over time then. So far, we are only talking about 71 trades. Nevertheless, as you can see here, so far we are in the green, and we just hope that this continues with another a profitable trade then for today. And I keep you posted on how things go. Yeah, and in fact, so this is one perfect example of how boring, in fact, trading can be, or usually is, when you found your trading approach. So it's not really emotional or something. You only formulate the setup, you type in the order, and that's it for the day. And then just see whether the market now makes it up to your target or it's probably stopped out. What you know is that over time, usually the numbers should play out accordingly. If you have a positive expected value in your trading, well, that means that you make on average more than you lose on average. You gain more than you lose on average, while the hit rate is around 50%. If this formula around the expected value is positive, all you have to do is keep on trading the setup and manage the risk accordingly. Only risk a certain amount, which is which you are personally comfortable with, and that's it, in fact. And we just can wait and hopefully see the market move, keep on moving in our direction, make another, I think it's 30 pips or so, 35 pips, and hopefully reach the take profit level then within the next hours of trading. So that's it around EURJPY. I'd also like to present you some thoughts on the DAX. Some of you recall that we also made the DAX here and the open range breakout system, which I presented now on EURJPY. We also formulated for the DAX several times, also for the S&P 500, something I want to have a look at a little later. But here, very interesting, I haven't taken any trades today. And the reason for that is simple, because the overall mode after last Thursday, that was before we had this triple witching on Friday, very, very interesting. We saw a huge extension on the upside. So I zoomed aggressively out of the chart to just show you the overall picture here. And we can see on the upside, there's a very, very interesting line here on the upside. It's 12,600 points. So if we click here on the daily chart, you can also see it. It's a very, very important level, this big red line here on the upside, 12,600 points, and this purple line. This is the simple moving average 200. And the simple moving average 200 and this high here from the last week of trading in August will be a strong, strong resistance line on the upside. And currently, by the way, gives the advantage to the DAX bears. So now the interesting question is, okay, why don't you take a trade today? That has a simple reason. I think the market is very extended on the upside, and before seeing, and this is, by the way, something I'd say I expected. In fact, before I expect this push towards 12,600 points, I'm not saying whether we break it or not. That's surely something which depends on the market conditions and the bias of the market participants. But I think there will be such a push. Nevertheless, I think it's too early to see such a push today. And that has to do with the fact that we are very extended on the upside after this push higher on Thursday. And so now with the big expiration through the triple witching on Friday, I think that chances are very likely or very high that the market will consolidate here at an elevated level and don't see a significant push on the upside, but also don't see a significant push on the downside. It's more like a corrective move over time, let's call it. So the market will consolidate here and reduce this extended mode, and then let's say probably on Wednesday, probably on Thursday, we have a good chance to probably see this slight push higher up to 12,600 points, in my opinion. Why is Wednesday very important? Remember, we have the Fed rate decision on Wednesday. And even though I have to say, well, I'm not very sure whether there will be high volatility in equity markets, but what I would say is we have a very good chance that the Euro USD, respectively all USD crosses, which means dollar Japanese yen, Euro USD, GBP USD, for example, will see high volatility. And this, the reason for that is in fact simple. The market currently strongly expects the Fed to hike rates. This is something you will see. Unfortunately, I haven't prepared this one, but let me just have a look here. It's a so-called Fed Watch tool. It's from the Chicago Mercantile Exchange. And there you can see the probability, how likely market participants consider a rate hike to happen. And what you will see is that there is not even one market participant currently to see the Fed not moving, something you can see here. So usually, let me just show it better. It's better if you go to 19th of December. No, that's not so. Okay, this is a little unfortunate because now usually you can see this column here, and if it's here, if you see those white lines within it, this is the current target rate, and you can see there is not such column, which means currently, which is here 175 to 200 basis points, market participants are expecting the Fed to hike rates by 100%. It's only the question, will it be only 25 or will it be 50 basis points? I think it will be 25, by the way, so this is a little too optimistic. But what's very interesting here is also when looking at the numbers around December, but also for the next year, we won't overcomplicate things here. We'll shorten things up, but look at this. So currently, market participants are expecting the Fed not only to hike rates once now in September, 25 basis points, but by another 25 basis points here in December with a probability of way over 80%. So it's nearly a done deal too. So what does this mean? It means nothing more than market participants will not look at will the Fed hike rates or not, but what they will look after is what's the communication, what's the rhetoric they use, what's the language. And I think every sign which is giving a hint towards the Fed not continuing with this aggressive rate hike cycle they're currently in. So with this, what we currently see here, the Fed would have raised 4 times in 2018. So March, June, September, and also December. And if they now give in their statement some hint that this won't happen in 2019, this could make a big, or has a big impact on the US dollar based on this one. This is the commitment of traders report here, showing the speculative positioning, large speculative positioning of 10-year T-note futures. And what you can see is we're looking at the green line here on the downside. And this is at a very, very extended level. Or put it differently, markets are heavily betting on the Fed hiking rates and yields going up. So they're aggressively betting on yields going higher. And this is a thing, if now these market participants are caught on the wrong foot by a Fed which probably says, well, we are not hiking as aggressive as we did within the last months here in 2019, or chances are high because we want to avoid to provoke the US economy driving or dipping into a recession here, because if we hike rates too aggressively, this could mean that we are strangling the economy and just avoid further economic growth to happen. So if these market participants are now caught on the wrong foot and have to scale back on their bets that yields will rise, respectively T-note future will decline here, this could result in a quite sharp drop in the US dollar. So the US dollar, in fact, couldn't really profit from this development here on the yield from a yield perspective, meaning yields went up while the US dollar wasn't capable of taking on momentum. In fact, as you can see here, that is last Thursday, there was this push towards 118 in the EURUSD, which is highly positively correlated to the US dollar, based on the fact that in the US dollar index future, we have 60% of weight of the euro here. So, and now the thing is that this is a perfect sign, in my opinion, that the US dollar is really weak and could see further aggressive weakness if now the Fed scales back into their rhetoric in terms of further future rate hikes here, which could mean the US dollar going sharply lower, especially against the euro, which is currently attacking a very significant region here of resistance on the upside. Or put it differently, if we go above 118.50 in the EURUSD, I think EURUSD could easily push towards 120, 120, 150, 122 within the next days. And yeah, so this is it around my thoughts. If you interested and say, well, that sounded interesting, nevertheless, it was very, very much information, please feel free to check the website from admiralmarkets.com, and here the tab analytics, and there the traders block. If you click on this and scroll down a little, you will see, oh, 1 second, by the way, I'll just update the website. You will see here my weekly market outlook and all the thoughts around the commitment of traders report. Just yeah, for you a chance to read through this again. And yeah, if you then have any questions, feel free to shoot them over to Admiral. They will forward it to me. I'd be more than happy to answer your questions. And yeah, so that's it from my end. So have a good start in the week.
Thank you, Jens. And maybe you go back to the 10 hot features for Forex trading. Our special webinar is on upcoming Thursday, if I don't make a mistake. Yeah, September 27th. So if you'd like to join us, we will present 10 hot features. Sorry for my German English. 10 hot features for Forex trading about indicators, expert advisors, many, many more things. So join. It's free webinar. Just register also here. Thanks for today. Tomorrow is another day, 5 days a week, 5 different traders. So hope to see you all again tomorrow. And if you'd like to see and watch that again, a couple of hours later, it will be available on our YouTube channel, like usual, any live webinar from us. Greetings from Berlin office. Thanks to Jens. Bye-bye.